Hello everyone, in this session we will keep working with the special revenue funds. In the prior session we looked at the purpose and the criteria of the special revenue funds. In this session we will work an example. As I mentioned in the prior session, to really learn about these funds you need to see the journal entries, you need to see the accounting part of it, you need to see how things flow into the financial statements, which is the end product. So knowing the purpose is good, knowing the criteria for each fund is good, but going over the accounting is critical. And this is what we will do in this session, work an actual example specifically for the special revenue funds. Make sure you're familiar with your modified accounting, whether you are governmental accounting students or a CPA candidate. You need to know this. Let's get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
So to illustrate the concept of the special revenue fund, we will work this example. As an illustration, assume the town of Lakeside maintain a tourism development tax fund as required by state law. So we are dealing with this special revenue fund, tourism development tax fund. You guessed it, it's helping what? Helping promoting tourism. Revenues include tourism development tax receipts, so they're going to impose taxes on certain things like maybe hotels occupancy, maybe tourist attraction areas, and federal tourism grant, and they would receive grants from federal government. Expenditure are incurred for promoting tourism and developing tourist attractions. So that's the purpose of the fund, special revenue fund. A legally adopted annual budget is not required or used, and assume that as of the beginning of 20X5, this fund, the Tourism Development Tax Fund, has cash of $300,000 and a fund balance for the same amount. So from a balance sheet perspective, we are starting with a clean cut. We have cash of 300, fund balance of 300. We don't have accounts payable or accounts receivable, which is due to or due from, which is we could end up with. But this is what we are starting with. So let's take a look at the tax revenue. During 20X5, the state notified the town of Lakeside that it would grant them $550,000 in tourism development taxes. Remember, part of the revenue is from the state or, the federal government, other governments. Record shows $475,000 was received in cash, and the remainder will be received within 60 days. Now, tourism development taxes are derived tax revenue. What does that mean? It means when we generate that tax, it's a derived revenue. It's derived from some activity. Again, as I mentioned, it could be hotel occupancy. Under modified accrual accounting, revenue are recognized when they become both measurable and available to finance the expenditure for the current period. So now the revenue is considered measurable because the town of Lakeside has been officially notified by the state about the revenue amount of $550. The exact amount of revenue can be quantified. Therefore, we can go ahead and record this revenue. Well, let's take a look at the expenditure now. Expenditure for tourism amounted to $480, of which $400,000 was paid in cash. Let's start to work with the journal entries. Well, starting with the $480,000, we're going to debit current expenditure or expenditure for tourism development. We're going to credit cash. We paid cash, and the remainder, which is not paid in cash, it will be accounts payable. Let's take a look at the revenue. For the revenue and modified accrual, as we mentioned, if they are collectible within the current period or soon enough after to pay the liabilities, usually the 60-day rule is a common benchmark, we can record them. So let's record the revenue. Cash, $475, due from the state government, which is they promised this much, they paid this much, it means we have a receivable, which is called due from. Due from, same thing as an account receivable, but in governmental accounting, we use more due from and due to when we have a payable. So this is the entry for the revenue. And remember, I should have mentioned this, we are going to eventually close the expenditure. This account will be eventually closed and the revenues will be eventually closed. Again, I'm just setting the ground for later on when we do the closing entries. And what's going to happen is we increased cash 475, we reduced cash by 480. So you want to keep track of what? Of those accounts, just FYI if you're keeping track of them. Reimbursement to general fund. Let's assume the general fund incurred $25,000 on behalf of the Tourism Development Tax Fund by error for tourism development expense. So the general fund spent $25,000. They should not have spent it. What do we have to do? We'll have to need to reimburse them because they paid for it, said whoever wrote this check made a mistake. This is not our responsibility. This is the tourism fund responsibility. So the Tourism Development Tax Fund will need to reimburse them. How would we reimburse them? We are going to credit cash and we are going to debit a current expenditure, tourism development. Because why? Because we're supposed to pay this, but we did not pay it. Now we're paying it to the general fund in a form of a reimbursement. Let's talk about, assume that the state awarded the town a grant of $400,000 for a major tourism development project. The funds will be released by the state only as the work is completed as a reimbursement. So what they have to do here, they have to spend the money and we will reimburse you. Well, revenues and expenditure for those type of situation are recognized simultaneously. So during X5, expenditure in the amount of $350 were incurred, of which $280 was paid. So they reimbursed this much. The town billed the state $350 and received $300,000. Well, let's take a look at these journal entries. First, let's record the expenditure. We spent $350,000, credit cash, and the remainder will be paid later, accounts payable. Now, the state promised to pay $350 as soon as we have the expenditure. So we're going to have due from the state $350 and we have a revenue of $350. Why? Because this is coming from the state, is in a form of revenue. Remember, this is revenue, this is expenditure. The net is zero, but we have to record them. But now we have a receivable from the government and the government only paid $300,000. We debit cash and credit this due to $300. It means we still have $50 due from the government. Now let's work the closing entries. I prepared you for this. Let's work the closing entries. We have tourism development tax revenue in total of $550. State reimbursement grant revenue of $350. Hopefully you saw those. Here's the $350 and I showed you earlier the $550 that needs to be closed. So we're closing this revenue. We're closing the $550. We also have to close our expenditure. If you add up all the expenditure that we recorded, they should add up to $855. So what we have to do is we have to kind of plug a debit or a credit for fund balance. And here we have expenditure of $855 and revenue of how much? $550 plus $350, that's equal to $900,000. So we have revenues minus the expenditure. We have a fund balance increase in fund balance. So our fund balance increased by $45,000. Does anyone remember what was the beginning fund balance? The beginning was $300,000. After year end, we generated an additional $45,000. Let's take a look at the statement of revenue, expenditure, and changes in fund balance. Revenue, we have tourism development tax, $550. I showed you how we recorded this. We have revenue from the state government of $350, total revenue of $900,000. Our expenditure total at $855, revenues minus expenditure, equal to that increase in the fund balance of $45. Basically, think of it as net income or net profit, but we don't have this. It's net change in fund balance, plus the beginning fund balance. The ending fund balance as of December 31st, X5, is $345,000. On the balance sheet, we have cash. We started with $300,000. We paid some cash. We received some cash. The net increase was $70,000. We still have due from state government $125,000. Total assets $495,000. We have an accounts payable of $150,000 and the fund balance of $355,000, which is we computed here, which is kind of the equity, in quote, the equity. Notice total assets equal to total liabilities, and fund balance. So what I did, I took you through a series of journal entries when it comes to the special revenue funds. Then I end up with the closing and end up with the final product, which is what? Which is the balance sheet or the statement of financial position and statements of revenue, expenditure, and changes in fund balance. What should you do now? You want to go to Farhat Lectures, look at additional resources that's going to help you, whether you are a governmental accounting student taking a governmental accounting and not-for-profit course, you're studying for your CPA exam or some other professional certification, or simply put, professional development. Invest in yourself. Good luck, study hard, and of course, stay safe.